A lot of financially responsible people quietly struggle with one question: should I buy a house or invest more aggressively in stocks? Most people compare these two using surface level math, focusing only on returns. But that misses the real cost entirely. The biggest difference is not performance, it is flexibility. In this audit, we will break down illiquid wealth, leverage risk, and psychological friction. By the end, you will have a clearer framework for deciding which structure actually strengthens your financial life. Most people treat this decision like a math competition. They compare appreciation rates and stock market returns and assume the highest percentage wins. But real life does not operate inside a spreadsheet. Buying a house is not just an investment, it is a multi-decade financial structure that shapes your lifestyle every month. It combines asset, liability, maintenance, and emotional identity into one system. Stocks are liquid and flexible, but emotionally volatile. These are not equal comparisons. Different assets solve different problems. Houses feel safe because they are tangible and stable. Stocks feel stressful because they fluctuate constantly. But that comfort often reduces flexibility, while discomfort preserves optionality. Most debates become tribal, claiming renting is wasteful or real estate is a trap. Neither is fully accurate. The real issue is resilience. A system that looks strong on paper can become fragile during layoffs, relocation, or unexpected life disruptions. The real question is not which asset has higher returns. It is which structure gives you the best combination of wealth, flexibility, survival margin, and emotional stability for your current life stage. A portfolio that looks impressive during stable periods can collapse under stress. Layoffs, health issues, or income disruption expose hidden fragility. Financial strength is not about maximizing returns. It is about maintaining control when life becomes unpredictable. Houses feel safer because they are physical. You can see them, touch them, and live inside them. That creates a strong emotional anchor. Society reinforces this by celebrating homeownership as success and stability. Mortgage payments feel productive because they build equity. They also act as forced savings, preventing lifestyle spending. Defaults matter more than motivation. This combination of visibility, discipline, and social validation makes housing emotionally comforting. Housing also feels stable because volatility is hidden. People do not check home values daily like stock prices. If stocks drop, you see it instantly. If housing drops, nothing visibly changes. You still live in the same space. This delay creates the illusion of stability, but hidden volatility is still volatility. Emotional calm does not mean financial safety. A structure can feel stable while quietly reducing your flexibility over time. Illiquid wealth creates a major financial trap. A house can make you look wealthy while leaving you cash constrained. Someone might have hundreds of thousands in home equity, but very little accessible cash. That creates risk during income disruption. You cannot use equity for groceries or emergencies easily. It looks like success on paper, but it does not provide real flexibility when life becomes unstable. Accessing home equity is difficult. You need a credit line, refinancing, or selling the house. Each option depends on market conditions, income stability, and timing. Selling is slow, expensive, and stressful. Repairs, commissions, and negotiations take time. This makes homeowners asset rich but option poor. During emergencies, speed matters. Illiquid wealth reduces your ability to respond quickly when life changes suddenly. Stocks work differently. You can sell a portion quickly without dismantling the entire system. That creates flexibility and breathing room. Liquidity becomes most valuable during unexpected disruptions. Many high-income individuals feel trapped because their finances are dominated by fixed costs. When income drops, the system becomes fragile. Flexibility determines whether disruption becomes a crisis or a manageable inconvenience. Stocks are emotionally difficult. Prices update constantly, and losses feel immediate. Media amplifies fear during downturns. Most investors believe they can handle risk until volatility arrives. Then panic takes over. People sell low and re-enter too late. The problem is not intelligence. It is emotional endurance. Behavioral mistakes destroy compounding more than poor investment choices. Stocks punish emotional instability. Houses punish structural rigidity. That is the real trade-off. Social media worsens stock investing by promoting unrealistic success stories. People chase hype and abandon discipline. Meanwhile, housing hides volatility. making it easier to stay consistent. Successful investors build systems, automation, rules, and reduced exposure to noise. Without structure, flexibility turns into chaos. Comparing rent to mortgage is misleading. A mortgage is usually the minimum cost. Rent is often the maximum. Homeownership includes taxes, insurance, maintenance, and repairs. These costs do not build equity. They preserve the asset. Many buyers underestimate these expenses. Over time, these hidden costs significantly increase the true cost of owning a home. A down payment removes capital from other investments. That money could compound elsewhere. Over decades, this invisible gap becomes massive. Meanwhile, stocks have hidden behavioral costs: panic, inconsistency, and emotional mistakes. One asset reduces flexibility structurally, the other reduces performance emotionally. Understanding these hidden costs is critical to making a realistic decision. Real estate appears powerful because of leverage. A small down payment controls a large asset. If the property rises, returns look amplified. But leverage also magnifies losses. A small decline can wipe out your initial investment. Regardless of market conditions, mortgage payments continue. Leverage increases both potential gains and financial fragility at the same time. When income is stable, leverage accelerates wealth. When income is unstable, it creates pressure. Fixed payments limit flexibility. People stay in jobs they dislike and avoid change. Debt begins to control decisions. A leveraged asset can build wealth while reducing freedom. Both outcomes can exist simultaneously. Buying a house makes sense when stability is the priority. Long-term residency reduces transaction costs. Life stages like family and community increase the value of permanence. A fixed mortgage provides predictable costs. Emotional stability also has value. Not every decision should maximize returns. Sometimes reducing stress is the better outcome. Stocks are better when flexibility matters. Early career stages benefit from mobility. Being able to move quickly creates opportunities. Stocks offer diversification, simplicity, and no maintenance. They allow fast access to capital. This flexibility supports adaptability in changing environments and often leads to higher lifetime earnings potential. Success with stocks requires discipline. Automated investing, long-term thinking, and ignoring short-term noise are essential. Without systems, emotional reactions destroy results. Most people underestimate how difficult it is to stay consistent during volatility. Structure matters more than willpower. Wealth is not about choosing the perfect asset. It is about understanding trade-offs. The right answer depends on your life stage. You must evaluate income stability, flexibility needs, and emotional tolerance. Strong financial systems reduce forced decisions and allow adaptation when life changes unexpectedly. Wealth is optionality. It is the ability to maintain control when life becomes unstable. Cultural pressure and spreadsheet math ignore emotional reality. The goal is not maximum theoretical return. It is resilience. A strong system protects both your financial future and your peace of mind during uncertainty. Start your audit now. Calculate how much of your income is locked into housing. Measure how many months you can survive without income. Define whether your current life stage requires mobility or stability. Then answer honestly. Would you choose flexibility or permanence today? That answer reveals more than any spreadsheet.